Let's bring in Barry Knapp, managing partner at Ironside's Macroeconomics, and Alex Roever, head of interest rate strategy at JPMorgan Securities. Barry, let's start with Barry. Barry, how do you see things playing out at this point? We haven't spoken in a while.
Good morning, everyone. A couple things come to mind in listening to your conversation with Steve. Look, there's been three stages to this panic. The first one was supply chain disruptions and the delay in the global manufacturing and trade recession. It moved on to then the consumer demand shock, which we're clearly now in the midst of, and then the financial panic. And on that one, the thing that I would point everyone to that really was overlooked last week, and you guys, Andrew and Steve's conversation just hinted around this a bit, which is really what kind of went haywire last week was the mortgage market. There's lots of discussion about the functioning of the Treasury market, but you had reportedly the single biggest creation of mortgage supply since the financial crisis on Tuesday. Some $19 billion in mortgages were created because of the burgeoning refi boom. Then, you follow that up on Wednesday and Thursday with also very big days, $10+ billion. So he created about $40 billion, yet mortgage rates actually went up on the week. And this is why, the Fed stopped the mortgage pay downs. They agreed to buy $200 billion worth of mortgages. If I was watching any particular part of the fixed income market this morning, that's what I would be watching. If you start to see that mortgage rate tighten relative to the Treasury rate and the mortgage market really start to function, that is the most direct channel for the Fed into the household sector.
Barry, what's that telling us, though? Why did rates go up, other than rates overall firmed at the end of the week?
It was just too much supply and a market that was stopping to function. So remember, the thing that kind of shocked even the equity market on Tuesday was when the stock market was going down and rates started going up. And that's the point when the so-called risk parity trade stopped working. That's undoubtedly when Dalio and some other people who run these kind of strategies started to run into difficulty. And it was just so much mortgage supply. And listen, the Fed has been transferring or shrinking their mortgage portfolio for some time. It's something I've been writing about how this mortgage prepayment option was being transferred back to the private sector, and it would eventually there'd be a problem. I thought the problem would be when they ended not QE, but not because of the coronavirus. But anyway, this getting the mortgage market to function is how the Fed can most directly impact the household sector. Mortgage interest as a percent of disposable income is at the lowest level since the Fed began tracking it in 1980. They can drive that mortgage rate potentially down towards 3%. That is a boom for the consumer on the other side of this. So that's really what I would be.
You say there's too much supply. What does that mean? Who's getting stuck here? Who's not stepping up to it? The banks don't want to loan to consumers at these levels. What does that mean?
You just ran out of buyers. I mean, by creating all this supply, you create a mortgage-backed security. Someone has to buy it, and the money management community, the bank community, they're all out of the market.
Well,
now, I would say that
who wants to get locked into these things for 30 years? I mean, it's a tough commitment for a bank to take on.
It is, and part of the reason it's a tough commitment as well, Becky, is that one of the changes from post-crisis was to make the cost of holding that mortgage servicing right, of actually holding the mortgage on bank balance sheets, really prohibitive. They jacked that risk-based capital charge way up. And if you look at bank assets, you see small banks are buying mortgages and holding them on balance sheet, but not the large banks.
Because they thought there were too many mortgages to people who shouldn't have got them, like ninja loans.
Yeah, but these are actually Fannie and Freddie guaranteed mortgages. So this is not really the same thing. They just made the cost of servicing it
Alex is
prohibitive.
Here,
so it's a regulatory failing.
Barry, thanks. Alex Roever, head of interest rate strategy, is joining us here from JPMorgan Securities. Can you explain what's going on, Alex, or at least add to the discussion here?
Yeah, so, I mean, looking at what the Fed rolled out last night, it's obviously sort of getting criticism from a lot of different sides. I think what they did will go a long way towards helping to stabilize the interest rate markets, which were in serious need of stabilization as of the latter part of last week. They've done a number of different things here. The rate cuts are sort of the most obvious. Maybe the less obvious are the asset purchases. They're going to buy $500 billion of treasuries to help provide liquidity to the treasury market, which needs it pretty significantly. They're going to buy $200 billion of mortgage-backed securities, which will help the liquidity that Barry's addressing. They're going to buy $40 billion of treasuries today. So why is that important? So we've been going through a period with a fair amount of uncertainty about the economy in the market, and obviously downward pressure on interest rates. That in sort of a technical fashion has led to an unwind of what's been a very large levered trade in Treasury futures basis, and a lot of that has wound up through various means, putting a lot of collateral on the balance sheet of dealers, to the point where dealers, I think, have been having trouble intermediating the market. The plumbing has gotten clogged. So I think a number of the things that the Fed has done with this package take care of the plumbing right now. So this, does it solve everything? Is it going to fix the economy and make the coronavirus go away? No, but it's going to stop things from getting worse in the system. They've also put in place things that I think will help the banks be better prepared, rather, to help out corporate and retail consumers. I think in terms of lowering the discount window rate, they took the discount window rate down to about 150 basis points, and effectively they've destigmatized it. What they've said is, after the 2008 crisis, it became, sort of verboten for banks to use the discount window. Now they're saying it's okay to use the discount window, and they're making it very attractively priced relative to the range out there. They want the banks to be able to provide credit to individuals and to companies, and so they've put in place things that will help them do that. They've also put in place a facility to help foreign banks get more dollar liquidity. So they're not just looking at the domestic banks; they're looking at the cross border flows. So these are all, I think, really powerful things for the markets here today. And then I would say the other thing that I think is important is I think they've been looking closely at the money markets. The money markets are always a key piece of the plumbing as things are flowing through here, and we started to get some clogging in the money markets last week. Given sort of the flight to quality that we've seen, the sell-offs we've seen in equities, we've seen something on the order of about $200 billion move into money market mutual funds just this past month. And so what that's done is I think it's created a lot of demand for short-term treasuries, so for bills, and bills have been somewhat scarce given the risk demand. It's also created demand for overnight repo. One of the things the funds are concerned about is they're concerned about this money could move out just as quickly as it could otherwise. So they're trying to be very conservative with their money. And so what we're not seeing is necessarily as much money being invested further out the curve. So prime money market funds, for instance, haven't been buying CP very aggressively. And part of that is they're looking at liquidity management. So hopefully some of what the Fed's done here will address that. Okay. It would help, I think, if the Fed gets to a point where they put in a CP facility that provides some directed credit. But I think that takes time. And I think what they've done here is things that they needed to do sooner rather than later.